Every day, roughly $500 billion of options contracts are bought and sold on the S&P 500. 61% of those contracts expire at the end of that day. These are called 0 DTE options, 0 days to expiration. They didn't exist 5 years ago. Today, they're the entire market. To understand why that matters, you need to understand what options actually are.
Today, if you want to hedge equities, if you want to protect your downside or speculate on the upside, you can buy a million different things. SPY calls, levered ETFs, options on the index, options on futures. All of those things are available. But there was still an immediate understanding when options were being used that if you buy an option today, you pay a premium to what the option is worth based on what is called an IV premium, implied volatility premium, relative to the likely realized volatility you're going to experience.
That premium, the cost of buying protection, has always been the friction in the system. Options cost money, and the further out in time, the more they cost. For institutions managing billions, those costs add up fast. 0 DTE looks like an option. They're cheap, they expire today. If you only need protection for the next 8 hours, why would you pay for protection for a month?
When an institutional investor is pursuing a strategy in which they don't want to buy long-term options because they think they're expensive, even monthlies or quarterlies or annual options, and so they choose to replicate with something cheaper. They use this dynamic process I've described already, called portfolio insurance, which means you sell a little bit, you lighten up your positions on the way down, and you build your positions on the way up. Now you can do that really cheaply and with incredible leverage by buying and selling 0 DTE options.
So on one side, you have institutions buying cheap daily puts, short-term insurance. On the other side, you have a growing group of traders selling those puts and collecting the premium, betting that the market won't fall today.
And 0 DTE options are broadly used for speculation because they aren't investments, they expire one day. So they must be something other than an investment.
And that gambling has been winning consistently, reliably, which is exactly what makes this interesting. To understand why 0 DTE has been so profitable for sellers, you need to understand what it does to the market structure around it. When institutions buy those puts every morning, they get cheap protection. The put sellers collect premium and stay short volatility. As long as the market grinds higher or stays flat, everybody wins. The sellers keep winning, keep doing it bigger, and the market gets supported on every dip.
Portfolio insurer can buy 1% out of the money puts, and buy 3% out of the money puts, and buy 5% out of the money puts, and pre-hedge for very low prices their deleveragings. So who are the sellers of those puts? Well, that's the thing. For the whole year, basically, except for a couple of events, every morning when the stock market is down overnight, gamblers come in and say, you know what? I'm going to buy the dip. I'm going to sell out of the money puts, 0 DTE or 1 DTE puts, and collect the premium because the market will never fall. And you know what? They've been right.
That's the self-reinforcing loop. Put sellers provide cheap insurance. Institutions don't need to deleverage. The market doesn't get hit with forced selling. Stocks grind higher and the cycle repeats. But here's what this loop actually does to markets and what most people miss.
Not only that, the fact that they sell them immunizes the portfolio insurer who is buying them. And so the portfolio insurer now doesn't actually have to sell on the way down because they've already bought the puts. So they're not a seller that accelerates a downside. The seller of the puts, all they have to do is hold it because it always works.
Think about what that means. The two forces that would normally create selling pressure in a down market are both neutralized as long as the loop holds. The market becomes structurally resistant to sustained selling. Every dip gets bought. Every vol spike fades. You can see it in the data. Look at the last 3 years. The drawdowns have been sharp. August 5th, 2024, the lead up into Liberation Day in April, but they've snapped back almost immediately. V-shapes. Over and over.
The drawdowns have been unusually sharp and unusually short-lived. And that's a very good description of what it's like when you have a market break due to forced selling. And all of those were extreme and V-shaped. And that's what you want to look at to say that zero DTEs broke in a way similar to what portfolio insurance has done. Then there are periods of one way up and to the right. After the breaks, after the August 5th of 2024, up and to the right. And now, up and to the right since Liberation Day.
That last part is worth sitting with. The pattern he's describing. Sharp, forced selling breaks followed by relentless grinds higher. It isn't just what zero DTE looks like. It's what portfolio insurance looked like in 1987. Before October. To understand why, you need to understand what's happening beneath the surface.
They have the ability to come into the market and hedge instantly. And so what that creates is it creates this false perception that you can hedge a big options book or a big long book instantaneously. And so what it's created is created a market that functions like an option selling program. And option selling programs, how they work is they go up almost every day, but they're prone to extreme drawdowns. And so there's nothing wrong with that, but you can run an option selling program that makes money for 1, 2, 3, 4 years. The Sharpe ratio is insane, but you're prone to a 50% correction at any time.
Smooth returns, low apparent volatility, extreme tail risks hiding underneath. And when you look at what's happening to volatility itself, it gets a lot more interesting.
So it's very similar to a 1987 or a portfolio hedging dynamic. It's just the option selling is more organic. There's more people involved. The computers are quicker. And so what you get is you get what is a perceived squishing of volatility, but actually the volatility is increasing. It's just like trying to compress anything. If you try to compress a store or you compress anything, as it compresses, it may appear that the volatility is getting less, but it's actually getting more and more. And that's only true for a short amount of time. And so what you'll see is markets will go down violently one day, but then they correct. They'll go down violently 2 days, but then they correct back up. But when you start to have the 3 and 4 days, that's when everything spirals out of control. You have market makers selling into selling, and then that dynamic breaks down. And so that's where the real crash risk comes.
A star being compressed. Volatility that looks like it's decreasing while it's actually building. That's the image to hold on to. Here's how Nik sees it ending.
And the zero DTE will be responsible for essentially the forest cleaning itself with a fire that grows exponentially. But then when it's over and all the people have been burned out, you have the blowing up of funds, you have individual investors that get blown out, you go right back to the steady climb up. So it's a false perception because the downside will be so radically fast, it'll be dynamic, people will be taken out of the game instantaneously, and then it goes right back to going up, and then people will say, hey, markets never go down again, you can never lose, when in fact the risk has never been higher.
Forest fire, compressed star, both pointing at the same thing. A system that looks calmer than it is, right up until it isn't. Here's the mechanical reason why.
Most zero DT options happen at the money or slightly out of the money. Puts are sold with a 1% out of the money strike or maybe 2% because we never fall below that. The day those things get washed out, they're gone after 3, 4, 5% move, and then it's over.
Gone in a day, which sounds like a safety feature. And in some ways it is, but it also means that the system reloads. The next morning, the sellers come back, new puts get sold, and the loop restarts. So here's the honest picture. Andy's not calling for a crash. He's not saying the system is broken. What he's saying is more nuanced, more important.
Zero DTE blow up pretty easily. It's not going to be pretty, but we're not going to have a stock market crash. Like 1987 has been regulated out of the possibilities. Now that doesn't mean we can't fall 20% in a day, and it doesn't mean we can't fall 40% in 3-4 days. We can, but the likelihood of such a thing is significantly impacted by the regulatory steps that have already been taken.
Circuit breakers, coordinated closing procedures, intraday margin systems. The infrastructure built after 1987 is real. That's what's going right. But there are two specific vulnerabilities that he's watching. The first is structural.
Back in the day, margin calls happened once a day. Now they could happen intraday. And so is the system set up properly for that? Are investors being treated fair? I do think there's probably some work to do at the brokerage level and how the client's risks are managed. That's the place where there might be some vulnerabilities.
Zero DTE positions can go from fine to catastrophic in a single trading day. The question is whether clearing and brokerage systems are built for that speed. And that's an open question because no one has actually stress tested it. The second vulnerability is harder to model. It's behavioral.
I think by and large, the people who sell out of the money puts, are just looking for insurance. They're saying, I'm willing to insure a crash isn't happening today. Now, the problem is they can get margin called. And when they get margin called, then they are forced to liquidate. But the fact is they haven't been margin called. So until they become consistently margin called, there's just a deep amount of capital for people who sell naked puts.
That word, consistently, is doing a lot of the work. One bad day doesn't break the culture. 2 bad days doesn't break it either. What breaks it is a sustained period where the trade doesn't work, where sellers get burned and start questioning the strategy that has worked 100 times in a row.
Right now, every investor who is a gambler has been heavily rewarded on any down day to sell puts and buy calls. It's a win every time. It works every time. And the one time it doesn't work, you get liquidated. Maybe we start to say, wait a second. I've been burned 3-4 times on these zero DTE puts that I've sold, and all my calls have expired worthless. Maybe I'm going to buy puts and sell calls. That would be a big flip. If the buy the dip culture died for an extended period of time, that could have a significant impact on the markets for an extended period of time.
That flip, the buy the dip culture dying, is the sign that Andy's actually watching for. Not a volatility spike, not a single day crash. A change in behavior, repeated losses that rewire how a large cohort of market participants think about downside risk. And here's what makes that hard to see coming.
So, yeah, it could end in a day, but the odds are it's not going to end in a day. So you ask yourself, how do you know it's ended? I guess I wouldn't even think about it ending until we have a down limit day. And the next day, not being a V bottom. We haven't had a down 5% day in forever, well, since April. Give a few 5% days back to back, and then that's when you start thinking maybe this thing is broken. But more likely, it hasn't, and we're just in for another V.
A few consecutive days where buying the dip doesn't work. That's the signal. Simple to describe, but almost impossible to time. And in the meantime, the system keeps functioning. The loop keeps running, and the market keeps getting supported on every pullback. That's where we are. A system built on logic that holds in a bull market. real vulnerabilities that haven't been fully tested. Not broken, not safe, somewhere in between.
And zero DTE isn't going to, I don't think, is going to significantly change that. Zero DTE is portfolio insurance.